Hey everyone, Tom Bowman here, and welcome back to another episode of Strategic Investor Insights. In today's video, I want to discuss a strategy that's been getting a little more attention from sophisticated investors, and that strategy is called a box spread. Now, this isn't your average options trade, and it's not a get-rich-quick scheme either. A box spread is much more like a tool. Specifically, it's an advanced option strategy that can replicate the payoff of a loan. And that's why some investors are starting to view it as a low-cost debt alternative inside of your taxable account. So let's start off with what is a box spread. In the simplest terms, it's a combination of options, both a bull call spread and a bear put spread, structured on the same underlying security with identical strike prices and expiration dates. Now, if you haven't watched my video on options yet, I recommend that you do that because we've covered each one of those topics in my previous options video. Something else that we've discussed in that options video that is important to note about a box spread is you are going to make this a European settled option. Because this strategy has 4 legs, or means has 4 options that you are trading, it's important that they all settle together at the end of expiration. So what does this all mean? Well, you're essentially buying the right to profit if the stock rises, that would be your call spread, and simultaneously profiting if the stock falls, that would be your bear spread. The end result is a fixed payoff at expiration, and the price you pay for that position reflects the implied interest rate over the period. So think of it like this. Say you construct a box spread on SPX options for a $1,000 payoff at expiration, and it costs you $970 to enter the trade. You've just locked in a $30 return over the period. That is essentially your implied interest over the period of the loan. It looks very similar to a zero coupon loan. Keep in mind these numbers are purely hypothetical and they do not reflect any open market observations at this time or any other time. So let's flip the perspective. If I'm willing to give someone a $1,000 payoff at expiration, I could receive $970. So if you sell the box spread, you're borrowing money today and paying it back at the end of the period. This is just like issuing a bond or just like taking out a loan. That's why people compare this to synthetic financing, because you're using options to replicate a low interest loan. Institutions have been using box spreads for years, particularly hedge funds and large asset managers, looking to borrow temporarily against equities in any way that can be both tax aware and capital efficient. But increasingly, high net worth individuals are also exploring box spreads in their personal portfolios, especially where margin interest rates are typically fairly high. In another past video, we talked about different strategies for concentrated stock risk management. Using box spreads to borrow against that concentrated stock could be one strategy that you take to free up capital against the stock without making a sale. So what's the catch? Well, let me be clear, the box spreads are very complex. They require margin, they require 4 legs or 4 option contracts, so execution costs do matter. And although the payoff is theoretically risk-free, in reality you do face a few risks. First, you have counterparty risk. That counterparty is ultimately the OCC, or the Options Clearing Corporation. Because this is the counterparty, you see very little credit risk baked into this spread, but there is still some counterparty risk. In addition, you have liquidity risk, these being European options and less traded. You do have to wait till the end of the period unless you want to risk poor pricing on the 4 option legs mid-period. In addition, you have tax complexity. And while box spreads are structured positively as far as taxes are concerned, you do have to contact your CPA to ensure it fits in your tax profile. These are not as simple as just taking out a loan. And perhaps most importantly, you do have constructive sale risk. If you're borrowing against the position, and especially if you're looking to hedge that position with options using a costless collar or other option strategies that I have mentioned in previous videos, you have to be extremely careful to make sure that you are structuring your strategy in a way that is not disguised as a constructive sale. Consulting both your CPA and your financial professional can help you make sure that these option strategies align with your long-term goals as well as your tax situation. So when might this make sense? Well, we've covered already that concentrated stock owners may be interested in using this to borrow against that concentrated stock. But another option could be somebody with a taxable account that's looking to take advantage of this lower cost financing opportunity to borrow against their portfolio and increase the size of their investable assets. And finally, someone may use a box spread to refinance debt at higher rates, considering this would be a lower rate. I have a taxable account with, let's say, $1 million or $2 million, and I have a home equity line of credit on a different house that is at, let's say, 7 or 8%. I may choose to use a box spread to refinance this debt. Now, because all of these strategies do tend to increase your total risk on the portfolio, it's again extremely important to consult a professional to ensure that you're managing these risks appropriately. Box spreads are not for everyone, but for the right investor in the right account, they can be a powerful and strategic tool. As always, this video is for educational purposes only, and that is the goal of my video series, is to educate investors on opportunities out there that they may not have heard of or looking to learn more about specific investment ideas. Options are complicated, and although I enjoy talking about them, I do want you to stay both informed and cautious as you look at these strategies. If you have any questions about whether something like this might fit into your broader financial plan and investment strategy, feel free to reach out to me, and I'm always happy to talk about the nuances of your portfolio. I'm Tom Bowman, and thanks again for watching Strategic Investor Insights.